Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We are kicking off to the closing bell here in the U.S. about 10 minutes ago before the close, and stocks were strong today. They stayed higher, Romaine, after the FOMC decision and press conferences. So it looks like we might close at our 49th record high this year.
Yeah, record highs all around for the S&P, the Dow, and the two major NASDAQ indices here. Of course, we talk about that Fed meeting, Scarlett. We got that rate cut, not necessarily unanticipated, 25 basis points, half of what we got at the September meeting, a recalibration of policy, if you will, as Jay Powell described it.
Yeah, and no commentary whatsoever on what's going to happen when it comes to the new incoming administration and how they might pursue policy, and of course, kind of keeping the door wide open for December. Whatever comes, they'll read the data and they'll figure it out. Yields are rising, so recovering from yesterday's sell-off, you can see a big move there, 9 basis points, or I should say, Treasuries are rising, yields are down 9 basis points, and the dollar at its session lows has pretty much stayed at this level throughout the FOMC meeting, off by 0.75%.
All right, so the press conference, of course, did not offer a lot of answers, but sometimes silence can say a lot. Jay Powell did have some things to say about the decision to cut interest rates today. Let's take a listen.
Recent indicators suggest that economic activity has continued to expand at a solid pace. We got one inflation report, which it wasn't terrible, but it was a little higher than expected. We're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points, and we're asking ourselves, is that where we need to be? We're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves.
The current chairman of the Federal Reserve, Jay Powell, speaking just a few moments ago as we continue to count you down to these closing bells. Ed Al-Hussainy is joining us right now, senior rate strategist at Columbia Threadneedle. And Ed, you listened to the press conference, you saw the statement, you saw the 25 basis points cuts, a recalibration of policy. I thought the last rate cut that we got back in September was a recalibration as well.
Yeah, I think they both were, and I think we're going to be on this recalibration train for some time, well into the spring.
Well, he was asked about, I guess, when recalibration ends, the idea of what the neutral rate is and when do we get there. As always, Jay Powell found a very elegant way to dodge that. But I will pose that question to you. Even if you don't necessarily know the answer, you have to have some sense of maybe where that ballpark is.
Yeah, I think you have to start with your view on whether the current stance of monetary policy is restrictive. And Powell was quite explicit. We're still quite restrictive. We're quite comfortable with where inflation is. We're quite comfortable with the outlook for inflation. What we are marginally uncomfortable about is the downside risk to employment. And that mix essentially puts them on a trajectory to continue cutting again well into the spring likely of next year.
Although he didn't rule out or in for a cut in December. When asked about the surge in yields, he said it's nowhere near where it was a year ago. Rick Reeder was on Bloomberg Television a little bit earlier and said that the bond market can only focus on one thing at a time. What's the focus right now? Is it on the strength of the economy or on the ballooning of the national debt?
It's true. The focus yesterday was I think, largely in part on the deficit and trying to digest the surprising result of the election. When we take a step back, I think we're starting to unwind some of the hedging. We're starting to unwind some of the money that was sitting on the sidelines is coming back into both risk and treasury markets. And I think what we're recognizing is that the economy is evolving in a pretty slow fashion. Growth is pretty stable. Unemployment is slowly drifting higher. Inflation is slowly drifting lower. And rates are kind of finding a rough equilibrium around that. I will say, taking a step back, inflation-adjusted rates, real rates at the moment at around 2% are quite elevated and probably have more downside.
The Fed updates its economic projections in December, but what's the value of any kind of forward guidance they can offer at that time if they have nothing concrete from which to work with?
It's going to be very tricky. I think we will get we obviously will get a new set of forecasts in December, but I think the Fed will be very explicit in saying the range of outcomes for next year is wide and wider given the fiscal uncertainty and the uncertainty around tariffs and other policies that are on the pipeline. And so policy making in terms of the next several meetings, the first several meetings of 2025, will very firmly be anchored on developments this year rather than what's in store for the rest of 2025.
And we have to address the fact, though, the direction of rates overall. I'm not talking about the Fed funds rates, but I'm talking about in the secondary markets. That's not just going to be affected by what Jay Powell and company do. Obviously, fiscal policy is a big part of that, but a lot of other policies. We saw the moves out of the election last night and the dollar. That's going to feed into the rates market. I mean, what are you telling your team right now over at Columbia Threadneedle? What are you telling your clients?
Yeah, think about where the 10-year yield has been over the course of the past 12 months. We started out as high as 5% in October of last year. We went down to about 3.6, 3.5 ahead of the September FOMC, and we've spent a lot of time in between. The fiscal outlook has not fundamentally changed, not yet. But we found that range in part because we get overexcited about the inflation story, we get overexcited about the growth story, both to the upside and the downside. And again, the truth is the economy is evolving relatively slowly. At the moment, when I look at real rates, inflation-adjusted rates, again, 2% across the curve, it seems that they're a little bit high, given how much work inflation has done, coming down to around 2%.
We talked about the stock market getting ready to close at another record high. Are the stock market and the bond market in sync?
I think they are. I mean, if you look at bonds through the lens of credit risk, corporate credit spreads are at 20-year tights. There's a lot of risk premium that's been bleached out of both equity and credit markets at the moment. It is a risk-on environment. And when you look at the corollary on the rate side, on the Treasury side, again, to Powell's point, in part, yields are up because the growth outlook remains pretty good.
Ed, I have to ask you one last question here. I know we talk about the potential changes in policy that could come. Do you get a sense here that if we get more clarity in January, once Trump is inaugurated and we've seen this cabinet, that we will see a material difference in tone in how the market trades this? Because right now this has been a fairly directional market and it's been fairly in unison, although it does shift a lot, but still fairly in unison. Do we think we're going to see more of a splintering?
I think it's going to take some time, in part because of the guidance we got from the Fed today. Think about what Powell said. The Fed is going to be quite slow in reacting and internalizing changes to fiscal policy. That keeps the front end of the Treasury curve relatively anchored. And so changes, anticipation of what the fiscal deficit is going to look like, that trajectory is going to get internalized into the long end of the curve. Expect perhaps some volatility there, but the front end well anchored.
All right, always a great conversation. Ed Al-Hussainy, senior rate strategist over at Columbia Threadneedle, helping us count you down to the closing bells here on this Thursday afternoon. A special post-Fed special as we move closer to those closing bells. A full breakdown of all of today's market action. It starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlet Fu, taking you through the closing bell, a global simulcast. It starts right now. We're joined right now by Tim Stenovic in the radio booth. Carol Masser has the day off as we welcome our audiences across all of our platforms, television, radio, and YouTube. Of course, a couple days removed from the election and a strange Thursday special Fed decision.
Yeah, what do you make of that? I almost said Wednesday earlier.
I know, it's kind of confusing here, but obviously they needed some distance from the election. But you got your 25 basis points, Tim.
You got your 25 basis points, and you also got a decision by the American voters. We were concerned that we wouldn't have a decision from the American voters by the time this Federal Reserve met and by the time that we heard from Jay Powell. So turns out they did a pretty smart thing by moving the day by 1 day.
Yeah, but Jay Powell was very, very careful, of course, to make clear he was not going to comment at all on the political situation or on what the incoming administration, what policy they might affect. So it was effectively a no comment through much of it. And the press conference was a lot shorter and a lot more tense, by the way, than what we typically see.
Isn't that notable that what we're talking about now is less about the path forward for rates, at least, and more about the way that he answered questions about what he would do if asked to resign or if other members of the Federal Reserve were asked to move aside?
And I think that's going to change in a material way, maybe not at the December meeting, but when we get to next year, because a lot of this is the monetary policy decisions are indeed going to be driven by the fiscal policy decisions, even if Jay Powell doesn't want to touch that. But he is going to have to address that, at least behind closed doors, most likely at that next December meeting. And my guess is it certainly was a topic of conversation in the two-day meeting that we just came out of here. today. Meanwhile, let's walk you through the market action here on the day. Interesting price moves. We're well off the highs of the day, but the S&P 500 holding on to a record high, up about 40 points or about 0.7%. The NASDAQ Composite and the NASDAQ 100 each up about 1.5% on the day. That's going to be good enough for a record high there. You see the Dow. The Dow had been trading at a record high for a good portion of the day. At one point, it was above right around that 43,800 level, but of course, it gave back a lot of that. And there you see the Russell sitting this one out a little bit, although it had shown a little bit of strength earlier in the session. Closing out the day, Tim, down 0.4%.
Hey, we're still in the midst of earnings season. It's not all about the Fed and the election. I'm watching what's going on over at Redfin right now. In terms of that outlook, the company sees a fourth quarter net loss between $25 and $32 million. That's coming above estimates of $24.1 million. The company says third quarter adjusted EBITDA came in at $3.95 million. Estimates were for $9.24 million. The company says third quarter revenue came in below estimates at $278 million. Estimates for $281.1 million. Shares right now bouncing around a little bit, but about 3% to the downside.
All right, I'm taking a look at Expedia because that company just came out with results as well. Third quarter adjusted EPS beating analyst estimates, $6.13, 3 cents higher than what was anticipated. Revenue came in a little bit lighter, $4.06 billion. Analysts were looking for $4.11 billion. But in terms of its full year guidance, Expedia, the online travel company, did raise its full year guidance. So we are looking at brighter skies, at least when it comes to the outlook, and that stock marginally higher. Actually, it's bouncing around at the moment here. There's also, in addition, a CFO transition as well taking place at the company.
Yeah, this is interesting too, and we should point out, I think we are expected to get some results out of Airbnb a little bit later tonight, so maybe we'll get a little bit more color here on the health of the travel industry. It gets to this idea, though, too, when we talk about the beneficiaries here of the big travel boom, that revenge travel, and whether that has ebbed. This raises a big question here, not so much about how they perform this quarter, but whether they can give some guidance longer term that will please investors. Tim?
Yeah. I mean, look, return of business travel, Airbnb certainly talked up the idea of people using Airbnb for business travel. The company itself has a policy of remote work. So in a sense saying, hey, you guys should do what we're telling everybody else to do. Yeah. But at the same time, since everyone is returning to the office, apart from Airbnb employees, does that affect the company?
Yeah, Airbnb was also very popular for people who were combining work trips with vacation trips because they were able to do more of that. And of course, as we go back to a more conventional work situation, that probably requires less of those long-term rentals at Airbnb places.
Yeah. That's why I was surprised to see.
Keep in mind.
I was surprised to see Romaine today after a few days in Detroit doing election stuff.
Yeah, me too.
Not
Tim.
extending that trip?
Yeah, trust me, me too, man. I tried to stay anyway. I was going to take a trip over to Windsor, Canada, but we need to take a trip right now into those earnings out of Airbnb. Crossing the wire right now, the red headline on the Bloomberg terminal is about the fourth quarter outlook. The company seeing fourth quarter growth in nights booked above 8.5%. The street was looking for 7.7%. That's the guidance for the fourth quarter. For the quarter that we just ended, the third quarter, gross booking value coming in above estimates at $20.1 billion. EPS, $2.13. The street was looking for $2.15. Adjusted EBITDA above estimates at $1.96 billion. Revenue also coming in slightly above estimates here. And and we're going to go back to the forecast here. So for the fourth quarter, they are saying that revenue in the fourth quarter, they're looking at a range of $2.39 to $2.44 billion. The street was looking for $2.42. So the top end of that range would beat that.
And just some commentary in the letter to shareholders. Airbnb saying that's building on robust momentum in September, off to a great start in the fourth quarter, citing strong demand trends across core as well as expansion markets. So again, to answer at least part of your question about what's going on in travel demand, so far, at least for a company like Airbnb, it looks like it has persisted.
I want to pose a question here, too, because it's interesting to see Expedia down, Airbnb up. And I think we had this conversation a few weeks ago when some other earnings were out. This idea that people aren't necessarily using these aggregator platforms to the same extent, that they're booking either directly through the airlines or through the hotel websites, or if you're a platform like Airbnb, maybe there. And I wonder if that has an effect on sites like Booking, Expedia, et cetera.
Yeah, I think that's a really good point. I mean, consumers sometimes, I know, face challenges when they're trying to change a ticket. Now that it's easier to change a ticket if you do it through a third party versus if you're doing it right through that platform. One thing that I also took away from just a brief glance at Airbnb's release is about hosting versus staying using using Airbnb. And you have to remember, this is a two-sided market here. Airbnb has to appeal to hosts to list their listings with the app, and also has to appeal to people looking for places to stay. What Airbnb is trying to do now is say that we want to make hosting as popular as actually traveling with Airbnb, as popular as staying in Airbnb, indicating to me that they're really trying to make the hosting experience better so people list with Airbnb rather than competing platforms.
All right, just a quick mention here of Lucid, the car maker, maintaining its full year production forecast, still sees full year production of about 9,000 vehicles. But for the third quarter, it did report a loss, an adjusted loss of 28 cents a share, slightly more narrow than what analysts had been anticipating. Revenue, $200 million. Analysts were looking for just under 197.
Speaking of EVs, Rivian also out with its results right now. 3Q production coming in at about 13,157 vehicles above estimates. Deliveries relatively in line at about 10,000. The company posting revenue of about $874 million. That's a miss. The street was looking for $980 million. And we're also learning right now that the company's loss per share coming in at about 99 cents a share. The street was looking for a loss of 92 cents a share. So a miss on revenue, a worse than expected loss per share. But at least right now, it does look like some of the production and delivery numbers came in either at or slightly above street estimates. Tim.
Okay, let's look at what's going on with Block, formerly known as Square. Third quarter net revenue coming in below estimates at $5.98 billion. Estimates were for $6.24 billion. The company sees a fiscal year adjusted EBITDA at $3 billion. It saw $2.9 billion. The estimate was for $2.92, so a beat there. The company also sees third quarter adjusted operating income at $1.56 billion. It saw $1.44 billion. The estimate was for $1.46 billion. Still shares moving lower in the after hours by about 7%.
All right, and we also have Pinterest, the social media network, reporting results. Let's start with the third quarter. Adjusted EBITDA, $242 million, beating the average analyst estimate, along with the third quarter adjusted EPS and revenue, also higher than anticipated. For the fourth quarter, this quarter, Pinterest sees revenue of anywhere from $1.13 billion to $1.15 billion. And at the high end, that matches the consensus estimate. So the outlook, certainly the range is lower than the median estimate. And in addition, its active users, monthly active users for the third quarter, 537 million. That is higher than what had been anticipated at 532.4 million.
Affirm out now with their results here. Of course, this is basically the fintech company, if you will. In the company's fiscal first quarter, revenue coming in at about $698 million. That's up 41% year over year and slightly above street estimates. Here's your guidance going forward, though. 2Q revenue, the company sees a range of 770 to 810 million. The street was looking for an average of about 783. Gross merchandise volume also expected to be slightly higher as well. Tim. All right, we actually got a few other earnings that we do want to get to here on a very busy day. Of course, a Fed day and a chance to catch up with some of the biggest investors out there. That does it for our cross-platform coverage of the market close on Bloomberg Television, radio, and YouTube. But we're actually going to stick with our radio simulcast and Tim Stenovec, who's sitting down right now with Cathie Wood, the CEO and CIO of Ark Invest.
Do appreciate it. We are very pleased to have Cathie Wood for her first interview since the election of Donald Trump earlier this week. Cathie, shares of your flagship fund, the Ark Innovation ETF, surged more than 8% on Wednesday. It was the best day in more than a year. Part of the risk on trade that we saw on optimism of a second term for Donald Trump in the White House. And that's where I want to start with you, because when you were back on with us in October, you indicated, without actually saying the former president's name, that you preferred a President Trump over President Harris, strictly from the standpoint of the candidate who you saw would ease the regulatory environment. So here we are. What does another Trump administration mean for you and the companies that Ark invests in?
Okay, well, thank you for having me on your show, Tim. Yes, regulation, critical. I think the regulations that have been creeping into the system, actually, they started to creep in. They've just flooded the system and really gummed it up. So the biggest regulatory issues have been around the SEC, especially when it comes to digital assets or crypto legislation, and the FTC. as it relates to M&A activity. I think both there are going to be big changes there. And that is going to be the beginning, I think, of a lot of regulatory changes. In his first administration, President Trump basically said, for every regulation you want to introduce, anyone in my administration, you must get rid of two. I think it's going to be maybe more dramatic than that this time around. And I also think having Elon Musk, who I think today announced that he'd like to name a new department, the Department of Government Efficiency, get that, D-O-G-E, Doge. I think he's going to come into the administration. I don't think he'll be a formal part of the administration. He'll be more in an oversight role, as I understand. Yeah.
Well, hey, Cathie, I want to jump in here because you mentioned a few things that I want to follow up on. One is Elon Musk. Have you talked to Elon since the election?
No, I have not talked to him since the election. I did see on X that he was part of the family as they were taking the picture around President Trump's acceptance speech. So, I know he's obviously had a tremendous impact on the election. I think he had X made a big difference, and his ideas around government efficiency, which will revolve importantly around technology. Artificial intelligence is doing wonders for the most bureaucratic organizations out there. We know from Palantir that it is having a tremendous impact on insurance companies, underwriting process timelines dropping from 2 weeks to 3 hours. And even in the military, Maven, Palantir's working on Maven with the DoD for targeting the enemy. They have shrunk that department. Don't need as many people. They've gone from 2,000 to 20 people.
Right.
Which it's pretty amazing what's going on. And I think we'll see a lot of attrition. Any employee leaving the government probably will not be replaced.
Okay,
I don't think he'll. I don't think he'll do $2 trillion in government spending savings in 1 year. That might be a 5 to 10 year. And I think between technology and attrition and lower regulations, maybe the abolition of certain departments, that they'll go a long way.
So you don't see him serving a formal role, but still overseeing some sort of Department of Government Efficiency in an informal way? Help me understand what you see him doing, and whether or not that could be some sort of threat to, he's a very busy man.
Yes, he's an unbelievable, he's the inventor of our age. I think I said that in 2015 for the first time when I was on your show with Carol Masser at the time. He is the inventor of our age, and he comes into a problem, assesses it with first principles thinking, doesn't care how things have been done, and comes back with ingenious solutions to big problems, whether it's autonomous mobility in the autonomous taxi space, or in the healthcare space, Neuralink. He's in the social network space, X, in AI, XAI, but and a lot of people say, and SpaceX, of course, the entire exploration, going to Mars. I think a lot of people can't believe he can do this. But again, he cuts to the quick, and first principles thinking, and surrounds himself with brilliant people who really want to solve the hardest problems in the world. And that's part of the secret to his success. Very high standards, and people who want to be held accountable to very high standards and want to really transform the world.
Hey, we're going to get back to Elon and specifically Tesla in a few minutes, but I want to go back to something that you mentioned at the top of our interview, Cathie, and that's the idea of some of the regulatory challenges that you said have cropped up over the last couple of years and during the Biden administration, specifically with regard to the FTC and the SEC not being present in a second Trump administration. How do you think the Trump regime will approach financial regulation, given that he's vowed to replace SEC Chair Gary Gensler? What does that look like?
Well, I think first, as it relates to crypto or digital asset regulation, they're going to replace Gary Gensler with someone who is much more open-minded, I would say, and will let the legislative process go to work. And, the SEC is supposed to regulate, enforce laws. They're not supposed to create laws by enforcement, which is what Gary Gensler was doing. So I think that's going to be important. I also think if you look at the public equity markets, I think the number of public companies out there right now has been cut in half in the last 15, 20 years. The regulatory nightmare of being a public company has kept leaders of companies basically saying, if I don't have to go public, I am not going public. And so I think we're going to see a lot more work in that regard to give, the average investor a shot at some of these moonshots. So I think that's going to become very important. As far as the FTC, the antitrust has gone way too far. They were denying mergers and acquisitions that really the companies were tangential to one another. They weren't even really in the same market. So we're seeing, and yet at the same time, we've seen these megatech companies grow into, massive organizations and dominating their market. So they were denying mergers and acquisitions for, think about JetBlue and Spirit Airlines. Yeah. That was ridiculous. Well, that was in the same industry, but one is going bankrupt now because they wouldn't allow that M&A. They were just dogmatic about it and didn't show to us at least any common sense.
So let's jump in. I just want to jump in because we don't have a ton of time with you, and I want to make sure we get to a lot, Cathie. So forgive me, please. You also mentioned last time you were on with us, you weren't wild about the idea of tariffs.
Of Bloomberg Radio, speaking with Cathie Wood, CEO and CIO of Ark Invest, and of course, I love the part where Tim asked Cathie whether she actually spoke with Elon Musk. She has not yet, but she did talk about how he has big plans and he wants to run the Department of Government Efficiency, or DOGE, Doge.
Yeah, hilarious. But what's interesting, though, I think, is just the idea of the structure of our portfolio and how a lot of what Cathie Wood, not only what's in some of those ETFs, but really what she's been evangelizing about now for several years. A lot of those companies have the potential to really be big beneficiaries from a second Trump term, not just because of Elon Musk's involvement, but she mentioned a few other companies, including Palantir, obviously the whole kind of Peter Thiel umbrella of companies, a lot of stuff that, of course, she has had an affinity for years now, and at least based on the market reaction you saw yesterday, maybe that's a harbinger for what we see in 2025 and beyond. Yeah, the restraints on those kinds of companies are going to be off because you have new regulators leading these different agencies, and certainly good news for someone like Cathie who sees these companies as leading us into the future. We want to turn back to the Federal Reserve right now because, of course, today was Fed Day. We got a 25 basis point cut, but in particular, one of the big dramatic moments of the news conference was about Fed independence. It's been a big topic of discussion after the election victory of Donald Trump. Chair Jay Powell was asked about it earlier today, and here's how he responded.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Joining us now to discuss this further is Betsy Duke. She's a former Fed governor herself and a former Wells Fargo chair. Betsy, great to speak with you. And Fed Chair Jay Powell was very, very clear in giving those responses. No, no, and not permitted under the law. And of course, we know that Chair Powell is a lawyer and clearly has probably studied whether the Fed has the legality, whether the president would have the legality of removing a senior Fed official like that.
I think that's true. And actually, in Trump's first term, he made noises about getting rid of Jay Powell. And I'm sure they looked at it then. I'm sure they looked at it before. It has to have come up before. But there is no provision under the law to remove anybody from the Federal Reserve Board. That's why they're set up with staggered terms. There are 14-year terms, 7 governors. So every 2 years, a term expires. And if you join the Fed not in a current term expiration, then you fill an unexpired term and your term still expires whenever the seat you're in would have expired.
Okay, so Jay Powell's term ends in May of 2026. He is cleared by the law to be able to stay in that position until then. There are a lot of question marks, though, in terms of regulatory action that the incoming president might want to take, particularly when it comes to financial institutions. And that the last question that we heard in the soundbite was in regards to Michael Barr, the vice chair who oversees financial supervision. How much can President Trump do with regard to the financial industry with the current structure at the Fed?
So with respect to regulation, the president can do a lot because you have other regulators, and typically you have the regulators needing to move forward on something like the Basel rules. So you have right now, he's already proved he has the ability to fire the head of CFPB, which he did with Richard Cordray. You have Marty Grunberg at the FDIC chairman. He has already announced that he'll leave as soon as his successor is appointed and confirmed. And then you have Michael Hsu at the control of the currency, and he's in acting position. So those 3 can be changed out really whenever the president wants to. Those are also 3 seats on the 5-member FDIC board, so that would give those 3 control of the FDIC board. So I think on that score, you have really quick change happening. My sense of the Basel rules is that there was already not agreement among the regulators. And so I don't think anything's going to happen there until you have new regulators in those seats.
I am curious, though, Betsy, we talk about this idea of the Fed being able to do its job, at least in the historical manner of which we associate with it. It's not only about the idea of maybe potentially replacing Powell or some of the other members, and as Powell, a lawyer himself, we should point out, made clear, at least from what we know legally, he cannot do that. But they did float this idea of a shadow chair. And I just want to bring up some comments that Scott Bessent made. He's a top Trump fundraiser, and a lot of people think he could be a front runner to be for the U.S. Treasury Secretary's job. The idea of having someone from the White House effectively in an official capacity looking over the shoulder of the FOMC members, how, if at all, could something like that work?
So the first point I want to make is that the Fed is independent with respect to monetary policy, but not independent with respect to its regulatory and supervisory role. There, it's accountable to Congress. But back to the FOMC, where would you put somebody that's going to do that oversight? Fed is independent from Treasury and is again careful. They work closely with Treasury, but Treasury does not influence their decisions.
This would obviously, this is a proposal that they have made clear that they are certainly considering. I have no idea what the legality of actually doing that. Maybe it takes an act of Congress, but it also gets to this whole idea, Betsy, and you know this, of the market's faith in the Fed, or at least in the independence of the Fed, I should say. Maybe they don't like their decisions, but the idea that those decisions are being made in some sort of honest and I guess to a certain degree academic way. I know Fed officials, Jay Powell himself, always like to say how they are not influenced by what's going on down at the White House here. Do you worry that could change?
Well, that's why it is so critically important to understand Jay's position there. That Powell's position is, I am not going to resign. I'm going to complete my term, and I'm going to do it independently. That's critically important. If anybody thought that Powell was going to just say, you know what, this is too much trouble, I'm going to go do something else and leave, that would call into question the independence of the Fed. I think the bigger question comes when his term is over, and who does the president put in the Fed chair position, and what commitments does that Fed chair make to stronger communication at a minimum, or even taking instruction from the White House on what happens to rates. That's just the chairman's seat, though. You still have all of the different voting members. You have 7 members of the board, and then you have the Federal Reserve Bank president. So it's going to take removal of the majority of those and replacing them with people who agree to vote in the way that the administration would like them to. So it's a little bit tougher than it sounds.
Do you anticipate there to be a tension or a confrontation between the Fed chair, who again can stay in his role until May of 2026, and the incoming president once he does take office, when the Fed meets each time and the President Trump has made clear that he favors lower rates? I mean, he can jawbone about it at press conferences. He can make comments about it to the media. At some point, does Powell need to respond, and how does that come to head?
I would be really surprised to see Jay Powell engage in any back and forth with the president. That's not the way the Fed operates, and that's certainly not his personal style. So I would expect to see more of what you saw today, which is those are things I'm not going to comment about. In the same way that he's not going to comment about fiscal policy. He's not going to opine over what's the right fiscal policy. He's simply going to focus on what does the economy look like given fiscal policy.
Yeah, and of course he made that clear that basically they wait until the laws are passed and basically on the books so they can have, I guess, a more accurate assessment of what the potential effect would be. This is a little bit of a broader question, less about politics and really just more about the direction of this rate cutting cycle and the idea that the fight against inflation that led us to all those rate hikes, it seems in the mind of the markets that fight has effectively been won. When you take a look at the economic data and you take a look at where rates are right now, do you think we are somewhere in the range of what neutral is supposed to be?
Well, first of all, I don't think rates are anywhere near neutral yet. And I think what you're seeing in the cut today, the likely cut in December, is getting down to a level that I think everybody would agree is still somewhat restrictive. You could have some discussion over how restrictive, but it's still restrictive. When you start getting down to, I think the highest estimate in the SEP for neutral rate was just under 4%. So when you start getting closer to 4%, then you start getting into, are we getting into neutral? Are we getting into easing? And those sorts of discussions. So
yeah.
A lot was made about the dots in the September SEP being sort of half for 75 basis points, half for 100 basis points. But and that was sort of interpreted as some sort of big dispute. I think it was really indicative of a very close call. Yeah. And I think when they went 50 basis points, everybody was on the same page at that point with an expectation of 2 more rate cuts. And then next year, I would expect them to go to, at a minimum, every other meeting. All
right, Betsy, we're going to have to leave it there. Betsy Duke, former Fed governor. A busy day here for earnings. Let's get you a roundup of some of the notable movers here in the after hours trade. That includes names like Rivian, Pinterest, as well as Airbnb. Jess Menton, Bailey Lipschultz, and Abigail Doolittle standing by right now. Jess, you're taking a look at Rivian.
We're starting off with those automakers, and particularly Rivian, because this is key. It's the first auto company to report after Election Day, and there's a lot of focus on what a Trump administration could potentially mean for those EV sales and growth over the coming years here. Actually, if you see that stock up about almost 3% in after-hours trading, its adjusted loss was about 99 cents a share for the third quarter. If you compare that, obviously, to the consensus estimates, lower than that. It was actually around 92 cents for a loss there if you look at those consensus estimates. But actually, what was key, though, was that it expects to have a gross profit in the final 3 months of the year. So that was something key that investors were focused on. But of course, they also want to see on that earnings call whether or not they'll have any indications about how they may try to mitigate growth. But then also another big thing is that budget-friendly model, the R2 that's supposed to come out in 2026. That's going to be something that traders investors really want to know and glean more insight to as it does get closer to that gross profitability in the current quarter. I know Bailey's looking at those social media stocks, though.
Yeah, Jess, we're seeing Pinterest under a lot of selling pressures, as you can see, down 14% in post-market trading. You look at the third quarter results, well, beat on revenue, beat on the number of monthly average users, but the guidance for 4Q falling below what Wall Street was looking for, revenue shy of the midpoint of Wall Street's estimates. We are seeing the company potentially talking down expectations for the holiday quarter. So fourth quarter, obviously around the Christmas and other holidays that are going to be critical for the company. It is competing, again, with the likes of Meta, with the likes of Snap. Those are two companies that touted their expectations around AI implementation, driving sales, driving growth as it relates to advertising spending. It does seem like Pinterest is spending. They did spend more in the third quarter than Wall Street was looking for, so that could partly be weighing on the stock. Again, down 14%. If you step back and looked at it on a 12-month basis, it's pretty choppy and it's below the 52-week high by quite a bit. But Abby, you're looking at Airbnb.
I am looking at Airbnb, and we're seeing quite a reversal just moments ago. In fact, when I was at my desk just minutes ago, this stock had been up about 10%, on pace for its best day since February of 2023. The current quarter nights booked, that is coming in. They're expecting 8.5% versus growth of 7.7%. That estimate weighing on the stock could be a couple of things. Relative to adjusted earnings in the third quarter, they did beat slightly. There was a small sales miss. But in addition, for the current quarter, the sales range, it's very, very wide. And the midpoint, the low end below, well below the street estimate. So that could be something weighing on this stock. In addition, this company's having a tough time this year, on the year up only single digits. But perhaps, Scarlett, there you can see the headlines that have changed the direction by 13% in after-hours trading in just a couple of minutes, again, from walking from the newsroom floor out to here.
All right, a lot of volatility there in that Airbnb stock in the after hours. Abigail, Bailey, Lipschultz, and Jess Menton, thank you all so much. We're also looking at a bunch of other companies that reported after the close, including Cloudflare, Sweetgreen, DraftKings, and Affirm, and remain all to the downside.
All to the downside. Interesting on Cloudflare, they're actually raising their guidance. Of course, this is the company that makes a lot of software, that powers a lot of internet sites, cybersecurity software as well, down 8% here in the after hours trade for the quarter. The company actually beat on revenue and actually beat on the bottom line here and beat on margins. But the guidance for the year on an adjusted EPS basis coming in above estimates, but they're maintaining their revenue guidance for the full year right where it's been. Maybe that's some concern here, why you're seeing the shares down despite the fact that they raised guidance on the bottom line.
Yeah, absolutely. And Affirm is in a similar boat, right? Because it had a first quarter loss of 31 cents, but revenue beat analyst estimates, and its outlook for gross merchandise volume was raised. However, it failed to match the highest estimate. So it raised it to $34 billion, or north of $34 billion, but the consensus estimate was $34.19 billion. So not quite good enough there.
And take a look at DraftKings, only down 5% now. It was down more than 10% at one point. That company actually cutting its full year revenue forecast. It also missed a couple of key metrics in the most recent quarter, despite the fact that revenue did grow about 39% year over year.
Yeah, just a quick mention of Sweetgreen as well, off about 6.5% after reporting a bigger quarterly loss and revenue missed estimates last quarter. All right, also moving earlier today was Moderna. It jumped at the open, but the drug maker gave up its gain and closed down about 3%, even as it turned a profit in the third quarter when Wall Street had expected a loss for the vaccine maker. Earlier, we sat down with Stephane Bancel, he is CEO of Moderna, where I kicked off the conversation by asking him about where he sees COVID vaccinations ending up this year versus last season.
So I think if you look at where we are today, in the retail segment, retail pharmacies, we basically are a little bit ahead of last year. The product was launched earlier because of the FDA approval. It is true that it seems that the weekly scripts have peaked and are coming down. The retailers are running holiday vaccination campaign leading into Thanksgiving over the next few weeks, and then between Thanksgiving and Christmas, leading into Christmas. So we'll have to see what does the tail look like, and that's for the retail market. It's important to also know that the hospital network and the government channels are also really important. Last year, they did not do much COVID vaccination. We have been working to try to increase that penetration of COVID vaccination in those two channels. We'll have to wait for the data to see how the season looks like. But what we can already see is that the decrease that we saw from 22 to 23 seems to not be happening this year. But again, we're still with 8 weeks to go into the fiscal year, so we will know more in a few weeks.
Stephane, you've been running this company, Moderna, now for more than a decade. You're intimately familiar with the regulatory process here in the U.S. We just had a major election here in the United States that is almost definitively going to change the course of healthcare regulation in this country, including the top job at the FDA and some of the regulators that you deal with. Do you anticipate that there will be any change in the process of getting your drugs from the lab to approval?
Well, it's difficult to know at this stage. As you know, the agencies have professionals that are doing this job of reviewing. Those are scientists and doctors reviewing the files. If, of course, the laws change, we'll have, of course, like the rest of the industry, to adapt to those laws. I'm convinced that this new administration, like any administrations, want to help the American people getting the best medicine. As you know, the life expectancy in the U.S. is lower than life expectancies in some countries in Europe.
Right.
There's a lot of work to do. So I'm quite optimistic that this administration, like other administration, wants to protect the American people, and we're going to be working very closely with them.
Well, I just want to put a finer point on that, because you mentioned the doctors and scientists, and obviously these agencies are largely made up of doctors and scientists. The front runners right now, at least if you believe the media reports, to head the FDA and some of these other healthcare agencies are decidedly not doctors or scientists. RFK Jr., a potential front runner for the FDA, has made it clear that he wants to change the regulatory process, including banning certain items, of course, that to a certain extent would feed through a company like Moderna. Do you have any concerns about RFK Jr.'s stewardship of the FDA?
So again, we will work with whoever is in charge of our regulatory agencies, like other companies. What is clear is I know the leadership will want to make sure to protect the American people, and we'll be working with them.
Okay, fair enough. But there is a mainstreaming of RFK Jr.'s skepticism toward vaccines. And I wonder what you think that mainstreaming means for the vaccine industry.
If you think about vaccines, they are an important component of public health and preventing disease. My understanding is this new administration, is going to want to focus on making sure there is more prevention, there's less disease. If you look at how do you prevent disease, you eat healthy, you do exercise, you improve your sleep, and vaccination is a key component in that. Last year in this country, we had 600,000 Americans hospitalized because of COVID with not enough vaccination. So I think especially the elderly can be really helped by having vaccines to prevent disease and prevent hospitalization, improve the quality of life, and reduce cost.
Stephane Bancel there, the CEO over at Moderna, fresh off the company's earnings earlier this morning. Scarlet Food, this is a stock that, of course, has been really hit hard. And I was just taking a look. It's actually down to its lowest level, get this, since early 2020, May 2020, to be precise. And that's a big part of the problem, right? Is they had this huge upswing because of the COVID pandemic, and everybody wants to know what's next.
Well, they have the RSV vaccine, but it only makes, what, $10 million in sales?
$10 million in revenue is the most recent quarter. How about that?
They need to work on some other things. All right, let's take a look at how the markets closed on the day. Another rally here for U.S. equities, the 48th record close of the year. Mag 7 names leading the way. Yields down today, but the 10-year yield still holding near a 4-month high. And the dollar giving back some of its recent strength. Little change after the decision from the Federal Reserve. This is The Close on Bloomberg.
Federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable.
Jay Powell responding to a question a little bit earlier at the press conference about the U.S. fiscal situation and how that could potentially affect monetary policy, reiterating comments that he's made in the past about an unsustainable path, but in typical Jay Powell fashion, certainly keeping his cards close to the vest as to how the Fed, if at all, would react to it. Stephanie Kelton joining us right now, professor of public policy and economics at Stony Brook University. And I do want to start there, particularly because the very first question of this press conference was about how the election would have an impact on policy. Of course, he, in typical Jay Powell fashion, found an elegant way to sort of dodge that, said, look, when the data comes in, we'll deal with it. When the new policies come in, we'll deal with it as well. Instead, what we got was a 25 basis point cut, a recalibration of policy as Jay Powell characterized it. 75 basis points of recalibration over the last two meetings, Stephanie. Is that going to be enough?
Well, I don't think that the Fed thinks it's going to be enough. I think they've made clear, we heard Fed Chair Powell say today, this is a strong economy. This is a strong labor market. You'd much rather be in a position of strength while you're cutting, because that's the coveted soft landing scenario that everybody has been sort of crossing their fingers and hoping that we would all get to enjoy over, the alternative scenario where inflation accelerates, unemployment begins to spike. We have this sort of hard landing story. We've managed to avoid that. I think it's clear that the Fed, with the first cut, that was not the first of one, that was the first of many. Mm-hmm. The easing cycle is underway, and I think, everybody anticipates probably one more this year, and then who knows for next year, 3, 4, and that's where the uncertainty lies. And what the Fed chair is telling us is that they're going to watch and see how things unfold and proceed, I think, with hopeful optimism.
Well, let's talk about that uncertainty, because I think everyone is really trying to read the tea leaves of what policy out of Washington overall is going to look like starting in 2025 with the new administration. And I know Jay Powell doesn't like publicly to talk about the fiscal side of things, but obviously that's going to be a big topic of conversation behind closed doors, because you cannot set monetary policy without having a real handle here on government spending.
Well, government spending is just one component of aggregate demand. So they're not going to ignore it for sure. But look, let's just be honest, okay? This is not unusual.
But it has been the main driver of aggregate demand for really the past 6 years now.
Well, no, I don't think that's correct, Romaine. I don't think fiscal policy or government spending has been the main driver of the economic expansion. It has certainly played an important role in supporting the economic expansion. And it's not unusual for a Fed chair to say the kinds of things that we heard Jerome Powell say today with respect to the unsustainable fiscal trajectory. He's been saying that for a number of years. Fed Chair Yellen before, and Bernanke before, and Greenspan before. They all said these sorts of things. Somehow, we continue to plug along, and no dangerous scenario ever seems to unfold in spite of decades of these sorts of warnings. So, yeah, I suppose we're going to continue to hear this sort of thing, because it has become, in a sense, boilerplate for Fed chairs to give these sorts of remarks. At the end of the day, interest rates are sort of their purview. That's where rates go. It's where the Fed takes them. There's some movement around the edges, of course, but at the end of the day, the Fed chair has an awful lot to do with where interest rates go. And to the extent that the debt and the deficit are increasing in an environment where inflation remains low, which is what the Fed is telling us they expect. If we're going to get to 2% inflation and sort of stay there, then it's pretty hard to see how the fiscal trajectory is unsustainable.
So, Stephanie, I want to fold in what the Trump administration is likely to do when it takes office, which is extend tax cuts and, of course, bring in more stimulus to the overall economy through the fiscal side. How do you see that playing out then in terms of what it means for demand and stimulating the economy? Is that going to goose inflation?
Well, it's a good question, and not all increases in the deficit are inflationary. And so I think we should be careful about using the word stimulus to describe what might be coming down the pike with respect to tax cuts. I can remember the discussion that unfolded around the 2017 tax cuts, and there was a lot of hand-wringing at the time. People were saying, why on earth would Republicans do this? The economy is already at or very near full employment. This is just going to create all sorts of problems. And of course, they went ahead with the tax cuts, and growth picked up a little bit. Unemployment went down a little bit. Inflation didn't accelerate. So when the tax cuts are structured in such a way that the lion's share of the windfall goes to people who will largely absorb that added income into savings as opposed to turning around and spending it. I think that that's the reason, at least I tend not to think of it as a really powerful form of stimulus that puts us at higher risk of inflationary problems. I think it's largely likely to look a lot like it did the last time around.
All right. Well, we shall certainly see, and we'll definitely get your thoughts on that as well. Stephanie Kelton, one of the best minds out there in the world of economics, professor of public policy and economics at Stony Brook University. As we continue our coverage here on The Close, stick with us. We'll be back in a moment.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Do you believe that the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
And that was central banker Jay Powell at the Fed's press conference, mincing no words that he will serve out his full term. The Fed's independence from the executive branch potentially at risk, given Donald Trump's comments in his first administration. Joining us now for his take on the GOP's economic policy under Trump 2.0 is Lanhee Chen. He's a David and Diane Steffi Fellow in American Public Policy Studies at the Hoover Institution and Director of Domestic Policy Studies in the Public Policy Program at Stanford University. Lanhee, always good to speak with you. I want to start with this idea, like just big picture. The Republican Party used to favor free trade, tax cuts, and deregulation. Trump is coming in, and we know the one thing he is very passionate about and has done before are tariffs. What exactly is the GOP economic platform today?
Well, I think it's certainly evolved from what we saw, let's say, for example, back in 2012 when I was working very closely with Mitt Romney. I think what we're seeing, of course, is a move toward greater reliance on industrial policy. Certainly, the tariffs are a core part of the president-elect's policy platform. And then, we'll be looking to see, of course, which industries might get a boost from a second Trump administration. Some of that approach we saw in the CHIPS and Science Act. I could see that being extended in a second term. So there's any number of different areas I think he'll go. But I think the first two priorities out of the gate will be the tariffs, which can largely be implemented by executive action, and tax cuts.
I am curious, though, about the complexion of the cabinet, at least when it comes to a lot of these sort of economic type of positions here, whether it's Treasury Secretary, Commerce Secretary, and the like. There were some fairly competent individuals that came in with him after the 2016 election. Are we going to see that same level of qualification now in 2025?
Yeah, I think so. I mean, if you look at some of the names that are being thrown around for Treasury Secretary, and obviously we don't know how much of this is real versus imagined, but my sense is that the people who are under consideration are all people who have a mix of either real world or policy experience. And you're talking about very important jobs in the United States government. I think that they'll be filled with people who are capable and certainly have a perspective that is going to be very much aligned with where the president-elect is. That's obviously a very important factor for him. So I don't worry so much about the qualification of people. I think the question is going to be the sequencing of agenda items, what to take from the president-elect on the campaign trail as reality versus bluster. These are all the sorts of things we're going to have to watch for as the transition develops.
The bond market, you can say, is signaling some alarm about rising national deficits and national debt. And you see that with rising bond yields. Do you think this is something that the Trump administration and Republicans as a whole will try to address in the next 4 years?
I think it's something that politicians of both parties have little interest in addressing, quite frankly. If you look at the voter signals that were sent, certainly a few days ago, the ones that have been sent over the last couple of years, the concern over deficits and debt is not nearly what it was, let's say, in 2010 or 2011. The level of interest in addressing those has declined, and policymakers react to that signal. So I don't necessarily think there will be a strong effort. I think the budget that we see from President Trump in February is going to make some effort toward discipline in some areas. But broadly speaking, I would say that there's not a lot of interest in addressing the bigger markers that really drive our fiscal crisis, which are mandatory spending and all the entitlement programs that no one wants to cut.
Do you think that there will be any sort of check coming out of Congress, or do you think Congress will largely be aligned with Trump on most of these issues?
Well, he's going to have a significant majority in the Senate, probably 53 seats, I guess, based on where we sit today, and the House looks to be moving in that direction. What you have to bear in mind is that a lot of these people who were elected, particularly for the first time this cycle, owe their election to Donald Trump's coattails. So it is unlikely you're going to see a lot of pushback from the House or the Senate on his agenda.
Lanhee, got to leave it there. Lanhee Chen over at Stanford University, of course, a former advisor to Mitt Romney, as we push ahead here to closing out the show with some of the potential market-moving events over the next 24 hours. And we start with some earnings out of Paramount. Remember that?
Yeah, Paramount, well, they're being sold and there's a whole M&A deal going on. So that's kind of the start of earnings season for the media companies.
Yeah, we also got the China NBC Standing Committee meeting as well, the last day of that.
Yeah.
And economic data out of the University of Michigan and Fed speak. It starts back up again, Scarlett.
Really? Again?
Yeah. Did you not get enough of it today? Well, prepare yourself. Bowman, Muslim among those speaking. More politics coverage coming up at the top of the hour. The team of Balance of Power is still here.